So we just went through the 4 buckets, and now I transition to the 10-minute lesson on life insurance. I will be doing an abbreviated version of this one. There is I like an abbreviated one that I do, but this is the full. If you're familiar with Circle of Wealth, then you know this conversation, and it's an excellent one. So we just got out of the buckets conversation. I go, all right, so I want to do just a quick lesson on the design of life insurance contracts. Now, I'm pretty confident what you're going to see you haven't seen before, and I don't mean that in a self-serving way. It's just what I've found to be true, and I want to give you an example of a client that I worked with here not that long ago. Let's just pretend for a minute that this is his insurance policy. Now, he came to us, or he came to me, and we did some work, and we looked at his buckets. We looked at the money he was contributing to his buckets and some of the money he had in his buckets, and he decided that he wanted to contribute $120,000 a year, which was a combination of some of the cash flow he had and some of the current assets he already had obtained, some of his accumulated money. He wanted to direct $120,000 a year for a period of time into his life insurance in order to create that tax-exempt bucket for him. So with the 120 grand, we took an application, we had him underwritten, and then the insurance company gave him a health rating. And with that rating, what we determined was the $120,000 would get him a policy, a death benefit of $2,800,836. And there's a reason that's very exact. So let's step back from that for just a moment, and let's just pretend he wanted a $2.8 million policy. If he were to get that in what would be a term policy, there would be that's the minimum that he would pay, right? A term premium is the minimum that you can pay. And that's normally how people shop for term insurance, is affordability. If some insurance company's offering you, the term policy for 10 grand and another one's offering you the exact same coverage for 2 grand, you likely go with the 2. So if he was truly just shopping for $2,800,836 of insurance, it would have cost him, with the health rating that he obtained, roughly just over $2,900 a year. All right, so there's a minimum that we can pay. And who determines the minimum? Right? It's not us. I mean, if we determine the minimum, we'd say, hey, insurance company, give me that $2.8 million for nothing. Right? It's the insurance company. We know that the insurance company, after they underwrite us and all that, they determine if we are going after a specific death benefit number. They determine what that's going to cost. In many cases, it's to the penny, right? $2,915.36 a year for you to get that exact death benefit. I mean, have you ever really wondered how those work, right? You take an insurance policy for $2,900 and you go get hit by a bus and your beneficiaries get over $2.8 million. These are cash cows for insurance companies. And the reason is there's studies, you can find these, that less than 2%, just barely over 1% actually, of term insurance policies actually result in a death benefit payout, meaning that the person actually died during that term. And, these insurance companies have all the actuarial data and all the statistics. They'll underwrite you for that 10 years, and they basically know whether or not you are going to die or not in that period of time. So the majority of these premiums that go to term policies through term policies for the insurance companies they're just cash cows, man. I mean, they're a very high profit margin for insurance companies. So we know that the insurance company determines the minimum. Now, that if there is a minimum down here, then that also means there's a maximum, but there wasn't always a maximum that we could contribute. There used to be no line up here on top. It used to just be like an open box. And prior to 1988, you used to be able to just dump money into these and get all kinds of tax-favored treatment. But in 1988, our government came out with something called TAMRA, Technical and Miscellaneous Revenue Act, and they changed the rules on insurance. What they did is they put a cap here. So what's interesting is the insurance company determines the minimum, the government determines the maximum, right? And the fact that our government limits and determines a maximum on how much cash we can be contributed into our insurance tells us one thing, and that it must be good, and it must be good in regards to taxation. And it is. So the government designed a limit. So they limited how much money you could shove in. You used to be able to do just a one-time payment. So someone had $1,000,000, they could dump it into an insurance contract and have all these benefits, and it would never be touched. It was a contract, unilateral contract of ownership. And the government said, whoa, 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 hold on. We're going to limit that. And now you've just got to make premium payments. You got to spread that $1,000,000 over time. But they didn't really say how long. You just had to make more than one premium payment. So the government determines the maximum. So here's what we did with this guy. We knew after working with him that he wanted to direct $120,000. We had him under it, and with his health rating, we tell the insurance company we want the smallest death benefit possible that is allowable by our lovely government in order to make this all about the cash, not about the insurance. You see, if he was truly spending $120,000 a year on insurance premiums, he'd have a significantly larger life insurance policy than that, because most of that would be going to the cost of insurance. But what we want to do in this strategy is we want to buy the smallest amount of life insurance we possibly can and dance right below this government limitation that allows it to be about the cash and not primarily about the insurance. If we violate that, if we all of a sudden are too strong or we buy too small of a life insurance policy, then we violate their rule that they established back in 1988, and they have the ability to tax money inside of the policy. So what do? We just don't violate that. So his 120 was going to, that exact death benefit was $2,800,836. And his 120 grand could get in there. And I mean, think about that. 2.8 million is not a very expensive policy. So what that means is the cost of insurance is pretty low, and this is a cash strong policy. You see, this is the paradigm shift. This is where people start to go, gosh, that makes sense. So think about this. Prior to this, if you and I went out and we're sitting at a bar and we're having a drink and we just start talking money and stuff and strategies, and I tell you, it comes up that my life insurance premiums are $120,000 a year, what would have been your thought about how much death benefit, how much life insurance I had? I'm pretty confident you would have thought, oh my gosh. And, stepping back from the presentation, people do. I mean, I asked them, like, what would you have thought? How big would that have been? Right? $10-20 million. That's right. It would have been huge. That's what your frame of mind would have been in, right? Because we've always thought of it as, what does it buy? Well, when we are using it to buy the smallest death benefit allowable by our lovely government, and allowing it to then be cash strong and focused on the cash, then that's truly maximizing the life insurance policy. So now this begs the question: if this guy could actually get this insurance policy, the $2.8 million for only $2,900, why would he direct, other than just being tax exempt? Why would he direct 120 grand a year into the policy? Well, it's because of all the benefits. So let's take a look at those now. Number one, we have tax deferred growth. Now, I say tax deferred because if it grows and later on in life you surrender the policy and you cancel the policy and there's growth in it, you could potentially face a bucket number 2 type of tax, a capital gains tax. But what do? We don't surrender policies. Number 2, we have tax-free distribution. Number 3, we have tax-free transfer to our spouse. Number 4, we have access to our contributions prior to age 59 and a half without any penalty. Number 5, we have access to our gains prior to 59 and a half. Number 6, we've got our tax-free death benefit. Number 7, we've got no 1099 whenever we leverage the policy. There's no communication between you and the government. Number 8, we have, because of there's no 1099, it's tax exempt. It is not means tested. So we get to keep all of our Social Security. We get to qualify for everything. You can have the food stamp card if you want to. Number 9, it is not subject to creditors. That one's huge. You ever wonder how O.J. Simpson did it? Man, he was found guilty, right? And liable. Well, he wasn't found guilty. He was in the civil case. He was found liable. And, but they couldn't get any of his money. This is why our politicians, this is why that guy does $500,000 a year into his. This is why the wealthy have shoved money in it. It's not subject to creditors. Now, it's a state thing, but most of them are 100%. Number 10, it is not subject to AMT, the alternative minimum tax. Number 11, has a competitive rate of return. Because of all these different features and the high distribution rate due to a benefit here in just a moment, you typically have to get about 8 to 12% in another investment after fees just to compete against this. Number 12, it has what's called a waiver of premium. This is amazing. So most people, if they're looking at a disability income or a disability insurance, it's just to provide income. It's just so that they can, not run out of money. Well, the insurance company will continue to fund your policy. So with this guy here, his $120,000, they would continue to fund his policy at $120,000 a year if he qualified for the waiver of premium. It's a health thing, which means that not only, hopefully he's got a disability income, but he now has, this is self-fulfilling as well, he now has the ability to continue to grow and accumulate. Waiver premium's incredible. Number 13, we've got chronic and terminal illness riders, which is great. Number 14, there is no risk. You cannot go backwards. You cannot lose. It's contractual. Number 15, you have unlimited contribution capability. If you kind of max yourself out, you can do a policy on your wife or your kids or your business partners. It's unlimited, which is awesome. Number 16, you have guaranteed loan provisions. You always have access to your capital. Regardless of market conditions, regardless of your personal financial health, you always have access to your capital. That's key. And because of that, number 17, it works and is designed to be used as collateral. A collateral spin down creates an arbitrage, which is a mathematically far more beneficial than a depleting spin down. And by the spin down, I mean when we're coming down the mountain and we're using our assets. If you're collateralizing your assets, it's a totally different animal instead of depleting. And see, this is why banks why it's their tier 1 capital, why they shove money into these things because of how they work. I'll demonstrate that here in just a moment. But first, let's talk about what this means to you coming down the mountain.